everyone. So it is Wednesday, the 2nd of December 2020. We're obviously heading into the Christmas season. And if anyone's interested, I mean, I'm always cautious of participating in the markets kind of from around about the 15th until about the 15th of December until around about the 5th of January. As a general thing, if you can take the break, take the break. Come back refreshed, come back inspired. Because during that period, you can either get nothing happening or you could get a very strong trend on something random like Euro Aussie. But it's really not worth the stress of having to manage trades. Look, it's an individual choice, of course. But that's just my 2 cents worth if anyone wants input on that. So generally, I've worked out after 10 years of trading that Christmas time, the best thing you can do to really come back powerful in January is to just check out, is to not actively do any trading from about the 15th onwards, give or take. Spend that time with loved ones, paying attention to them, and time with yourself, and so on and so forth. So the point of this particular episode is to do a much more in-depth analysis on gold and kind of what could be expected over the next let's say 2 to 10 days in terms of its outlook here. So if we look at the monthly, if you follow my stuff at all, you'll know that I've been waiting for that kind of correction to 1800. So those levels were based off historical levels. For those who care, I'm a purely technical trader. All right, in my journey as a trader, I was fortunate enough to encounter a technical trader, Nick McDonald, in 2011, 2010. And up until that point, I had been battling with trying to integrate the kind of fundamental events into my technical trading, which is still very common today. And actually, I found it to be massively problematic. It was one of the biggest, can I actually succeed at doing this? It's a battle every day. And the second I'd been monitoring Nick for a while, his decisions were always technical. Although it's not to ignore elections or high impact news events, not to ignore them, but the trading was always, the decisions to take a trade were always 100% based on technicals. And so when I decided ultimately to do that, I found same thing, my trading improved dramatically. So the lesson being that for me at least 100% technical. And it's very interesting because when I attend seminars, when I'm speaking against other alongside other kind of colleagues in the industry, I've very, very rarely meet anyone who's purely technical. They seem to feel that for them, including the fundamentals is absolutely crucial. They need to have meaning as to why the market has done what it's done. Whereas as technical traders, we shouldn't be concerned with that. We're following price action. And so for me, I'm drawn to technical traders who follow price action, who are incredibly objective in their analysis, unemotional, and their results are usually phenomenal. They usually outperform the fundamental traders, in my experience anyway. So let's have a look at gold. So gold, I had been waiting for a correction to the 1800 level. So there's a reason behind it. It's bullish. Now, it broke out through a level of historical resistance, which it had been in since 2013 until 2019 broke out, but it didn't really come back and retest it. So that can often happen. It doesn't have to happen 100% of the time, but it should happen most of the time. It didn't do that. Instead, what it did was immediately went up to the previous, or at least to the next key level. Mine are color coded, so green is monthly, red is weekly, and blue is daily. Straight up to that, then broke through that. It did effectively a spike through. This is that period earlier this year where the coronavirus had an impact across every single asset class. So that was February and March. So it did do that. Technically, you could argue it came back and retested it, but not really the kind of way in which I would expect it to do. Shot on, broke through the next level at 1800, continued on, did not, strictly speaking, come back to retest that, broke through 1900, the next key level, and then broke through 2000, and it just never really came back to retest that. So at that point, it became incredibly overextended. I'm comparing that to the last time we had a bit of a bubble in gold. And so the result after the bubble of gold is that it effectively lost its luster, no pun intended, until 2019. So can you imagine that from 2011 to kind of come back down and lose value until like 7, 8 years later. So just when you think something will never ever correct, it can, and it can struggle to recover from that for a long time. So point being, gold is absolutely due for a correction. The minimum correction, in my opinion, would be not going to be a very shallow one. It would have to be about maybe a 382 retracement. So the more overextended price action is, the more reasonable it is to expect a 382 as a minimum retracement. So in fact, that's kind of what happened. I was expecting, and if you go back over the last 3 months, I've been talking about this for a while, expecting price to come back to retest at the very least 1800, which it appears to have now done. The furthest that I believe it could have gone would be somewhere reasonably, somewhere between a 1600 and 1550 into this area, which puts it at these key levels around about here, which puts it at the low end of the moving averages, and therefore would be more closer to a 618 retracement. So that area there representing a 386, sorry, to a 618 retracement. Now it's pulled back, and it has produced so far a bullish monthly candle. So we're only a couple of days in, literally into December, so it's very early, and this is what I want to talk about. So on the one hand, because we have to basically look, it's like chess. We've got a number of different potential outcomes here, and we have to navigate them as they unfold. So trading is really about being able to assess what the reality of the situation is objectively, assess what are the minimal number of ways in which it can potentially play out, and then have a trading plan around that, and then just navigate that as it comes out or as it plays out. You might have to adapt. You might have something that sets up to play out one way, but then in fact turns around and plays out the other way. That all of those situations can happen. So price has pulled back, currently producing a bullish candle in this area. So for me, this is a very acceptable retracement, and therefore gold is fully justified in returning back up to 2000 at this point, and potentially further. It's justified. It's had a decent minimum healthy retracement. I'm very happy with that. After having been cooped up since 2013 to 2019 for 6 years, a breakout of this matter explains to me why it surged past all highs and is now potentially taking a bit of a breather, but is still really good to go. So I can accept that. At the same time, as I said, a pullback down towards 1600, 1550 is technically still possible. Forget about the instrument. Fibonacci shows us, experience tells us, gold is not bulletproof. It can lose value. So there's no fundamental reason at this point why. The fundamental explanation, if it did have to drop down, would suddenly become apparent down the line. So I'm not concerned with that. Technicals will just show me what it's potentially going to do, where those key price levels are. So you must remember that before charts even existed, if you go back to before charts existed, the markets were based on price. People would be sitting at the stock exchanges or at the market, going and buying off numbers that was price. And so they would have either psychological value or just market value. And all we are doing now is marking what those price levels are, and then seeing if the market can stay above them or not. And if it can't stay above them, it has to drop down to the next key price. That's really just how the market works. We've overcomplicated it. And so that's really on us. So to simplify it, key levels will really dictate that. So plan A is that price will attempt to stay above 1800 to produce a bullish candle, which will then take off and continue on up to that. That's in line with the longer term trend for gold. The trend is currently up, high lows, high highs, which means that it's innocent until proven guilty. So at this point, our plan A must align with the existing trend that it is going to continue up. So is there still a possibility that it could fail over December, end up as a red candle, and therefore end up lower, and then the implication being that it's going to head down towards, probably closer towards 1600, 1550. Yes, that is a possibility. So how will we know that? So now we have to start to look at the different levels. We have to look at it in a little bit more detail. On the weekly, we have a downtrend. We have lower highs, low lows, predominantly, or at least we're more bearish than we are bullish. We have produced a bullish candle here at a key level. That's really what's important here. A bullish candle so far at this. But the daily is still very much in a downtrend. So when we go to the daily, this is how we need to manage what's going to happen on the daily and what does it reflect on the monthly. I'm just looking at the time. I hope to keep this under 20 minutes. But what does it reflect? It's a special edition. So this is why it's worthwhile spending the time. So what happens on the daily will potentially be extrapolated up to what's happening on the monthly in terms of what could be the potential outcome. In the monthly, it's very straightforward. We're either going to set up and get ready to go long from where we are, or we're going to fail to do that and head down towards 1600, 1550 on the monthly. What would that look like on the daily? What would those potential outcomes look like on it? So in isolation, if we had no idea what the monthly looked like, the daily would be in a nice downtrend, and the potential outcome here, so let me just go and grab a particular I'm trying to do some drawing here, so bear with me. I'm going to try the drawing tools. So if it was in a downtrend, which we could see the lower highs, lower lows, it's reasonable to expect the price could continue down from here. In order to do that, I would need to see in the next 2 to 3 candles, in other words, by the end of this week, because it's Wednesday, I would need to see a red bearish candle form in this area. And what would be beautiful would be to see it do that up against these previous levels of support as resistance, as well as potentially multiple Fibonacci retracement levels measured from these highs to these lows, and maybe a cluster if measured from there to there, as well as maybe a monthly or weekly pivot. So in other words, this area here becoming the furthest I think it would reasonably retrace to. So let's just see if I can erase that or clear it, and then go back to it. So this area, therefore, becoming a very viable area where price could encounter resistance. That would be great. So anywhere in that area finds a fib level, encounters resistance, the minimal area being here. So anywhere between these moving averages here, I could also produce a bearish red candle, which actually means either today, by the close of today, tomorrow, or Friday in this area. So in other words, this would be resistance if price comes up, because remember that price does not always have to come back up or back down to test support for resistance or resistance for support. It doesn't have to. It can just pull back into a 382 or back into the moving averages and carry on down, which is why I've included this area to be tested for as resistance and this area as the earliest turning point in terms of moving averages. So those are the areas in which I would expect price to find resistance and resume if the market was potentially likely to head down towards 1600, 1550 area. Barrier. The moving averages of the MACD and the RSI are bearish. That implies that the trend is bearish, effectively. The trend is bearish, and at this point in time, it's implying, actually, that price is going to continue down. That's what they're saying. Okay, so what would be the... That's the cleaner. So I'm going to pause. I'm going to come back to this. That's been sorted out. Okay, I'm back. Everything should all be sorted now. So just to recap. Overall, the momentum indicators are bearish, implying that the trend is healthy, and therefore the probabilities are it's going to continue down. So bearish candles in here. You could get a situation where you get a small red candle, then you get an outside bullish candle, then you get another red rejection candle here, and then it continues down. So you would get not a fake setup, not a bear trap or anything like that, just what happens. The bears return, the sellers return, but they fail. There's not enough of them. Price goes up, there's more sell orders here, and then it continues down. So that's plan A. And that's if the market is unable to, or is planning, ultimately intending to go that way, then that is what I would expect to see in this area. So what would negate that? So what would negate that would be if the market did something more along these lines. So instead, the market ultimately breaks through the level, breaks these highs, or obviously there's a series of highs that are kind of range bound here, but also these highs. So obviously it just breaks through that. Then the implication of that immediately on the monthly would produce a very bullish candle on the monthly. So there's a connection between what's happening on the daily and what the implication is on the monthly, and therefore back to the daily, what I should be preparing to do. So then I could be looking for long opportunities here, price to break through this monthly level, long opportunities here, and then starting to work my way back up towards the highs. Those are really the cases. Should price, so let me remove the drawing tool and then go back to this. Should price start to head down towards these lows, then my trading plan becomes obviously looking for shorting opportunities on intraday levels or kind of lower levels, which for me is the 15 minutes up to the 1 hour, up to the 4 hour. Quite happy to do that. And really looking to see if price is going to work its way down to these levels. And then again, what I'd be looking for is to see price start to form a basis and then start to climb up, and then I can start looking for longer term opportunities. Now with oil, for example, so with oil I had a much longer term downtrend. It was really cool because The monthly was bearish, the weekly was bearish, daily was bearish, and it just rejected that. So that's fine. Look, that's going to happen, but that happens so rarely. When it does, it's significant, but that doesn't happen most of the time. That would happen, honestly, in the majority of times, in my experience, that's 1 out of 10 times where that kind of significant shift is going to occur. And it's not a bad thing. It just means what would you have to see in order to go, okay, the market is now more bullish than it is bearish, or more bearish than it is bullish. So here we see price heading back up, and so that's the case. Now, will price head down if it's going to go down? Will it head down in a beautifully orderly fashion? Not necessarily. This is what happened here. We had a really nice bearish breakout setup. Boom. My expectation was it would go straight down to here, and it didn't. It messed around here. Excuse me for a second. So, and that's kind of, and then instead of messed around here and then tried to break up higher and failed to do that, and then kind of submitted and then came back down. On a monthly perspective, it wasn't really a big deal. It just ultimately looks like a retracement, but on the daily, it became very much untradeable in this area. And so it can still do it. It could do that. It could decide at 1700 to do the same thing. But this is so I've described to you kind of what is my plan A, what's my plan B, and there isn't an unlimited number of ways in which it can unfold. There's a finite number, and it's less than 10 different ways in which it can unfold. It surely can't be beyond that. It's either going to break to the upside, or it's going to turn down here and head, and then it's either going to consolidate, or it's going to behave, and it's going to go all the way down here. It's like there's a limited number, and so I'm just going to be prepared for that. But because I can't predict if it's going to do it in an orderly fashion or not, this is why I take profit at 1-to-1, because the idea and principle is sound, but the way in which it unfolds might not be that smooth. Okay, remember, because it's a commodity, the cheaper it gets, the more attractive it becomes to buyers, and therefore they'll buy. So as it goes down, it does actually attract buyers who want to come in at those levels, and therefore it finds support, like stocks find support really easily. There we go. So that's going to be my approach, and then we'll see how long it unfolds, and what's going to happen is it's going to break to the upside, and then I can start looking for longs. Then do I have to see it kind of starting to do it here, and so on and so forth. But that's pretty much it. Encapsulated why it's on my watch list, what I'm looking for in order to become bullish, to become bearish, what I'm looking for on the higher time frame, and how I use the higher time frame to weight whether the market's going to be more bullish or more bearish, and therefore to adjust my approach in the morning or for the day on the lower time frames. Here we go. Thanks.